So here we go with the job losses. First, Microsoft starts out its new year by announcing 9,000 in job cuts, roughly 4% of its workforce, so a significant hit. And this was totally on the nose given what ADP reported for the overall labor market. A shocking and totally unexpected minus 33,000 for the month of June. Yes, minus 33,000. Here come the job losses. And I told you this was how it was going to go. They started out this year saying the labor market was strong and that layoffs weren't happening. And economic conditions have deteriorated. Now they're admitting, well, okay, there is some firing taking place, but it's not a huge amount, so we're all good. Or they'll say this is just ADP, so who cares? But it's not just ADP. It's not just Microsoft. The evidence for an economic inflection is all over the place. We just went over this 2 days ago, how consumer spending is down for the year. A 5-month negative, the likes of which we haven't seen since either 2020 or 2009. This thing is real, and it's showing up in data coming from everywhere, not just ADP or not just from Microsoft. This right here is the macro side for the deeply negative swap spreads. We went over yesterday the monetary end of that, but in terms of economic conditions, what will get interest rates down and down a lot, like they've been pricing in the swap market, more than negative numbers proliferating in spending and now job data. As CNBC put it today, a possible sign that the economy may not be as sturdy as investors believe as they bid the S&P 500 back up to record territory to end last month. Stocks are going to do what stocks always do. The real markets, they've been pricing and warning this was the direction the world and the U.S. economy was going to take. And now the data keeps coming in confirming all of it. Even central bankers have shifted their tone and their tune as well, not just in their actions. Here in the United States, they said, well, layoffs, they're not going to happen. And then when they started to show up, they said, well, maybe there's a little bit of firing, but it's not pervasive. And then a couple months from now, they'll say, well, okay, the firing is pervasive, but at least it'll only be transitory. The entire economy is shifting, and so is the narrative behind it, because the information, the evidence is overwhelming at this point. So let's start with Microsoft. They provided a fitting headline for a day like today when we get some negative labor market statistics. The Seattle Times reported earlier this morning, Microsoft is kicking off its fiscal year by laying off thousands of employees in the largest round of layoffs since 2023, the company confirmed on Wednesday. In an ongoing effort to streamline its workforce, Microsoft said as much as 4%, or roughly 9,000 of the company's employees, could be affected by Wednesday's layoffs. Microsoft said the cuts would include multiple divisions across the company, but did not specify early today which teams would bear the brunt. Reports over the past 2 weeks from Bloomberg said sales and marketing employees as well as gaming workers would be heavily affected. What Bloomberg said this morning was, Microsoft is one of the world's preeminent profit-making machines. It posted more than $96 billion in net income over the last year and has a market cap north of $3.6 trillion. Yet this week, it will be firing thousands of workers in a second major round of job cuts this year. Why? In part because artificial intelligence is expensive. Only in part. The other part is macroeconomic. After spending tens of billions of dollars on data centers and AI application development, Microsoft pledged to Wall Street that it would put a lid on all of these costs. And it's more evidence that the AI bubble and the AI building boom, while that's maybe good for the future, it is not contributing to the economy of the present. Or at the very least, it's nowhere near enough to overcome the existing forgot how to grow challenges that are only getting worse. Now, it may pay off down the road, but down the road is getting farther off into the distance. In other words, the AI bubble, which has tons of bubble properties, but whose broader macroeconomic benefits, if they do pan out, are almost entirely absent right now today. Apart from some spending on data centers, for the broader economy as a whole, Microsoft, what they're doing as far as layoffs is more accurate or more consistent with the picture that we have today than any future boom led by AI technology. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store value hedge for years. In fact, it's the ultimate error hedge. While gold prices are at an all-time high, price appreciation isn't the only way to profit. You can earn a yield on gold paid in gold without selling your metal. When the price of gold increases, so does the cost to store it and insure it. Don't lose money owning gold, earn a yield on it instead. And Monetary Metals allows you to earn up to 4% on your metal in their gold leasing program. And you start earning that 4% yield immediately upon funding your account. The yield you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. So that disparity fits with what ADP reported earlier today. And I love how CNBC put it right in their headline. The headline said, the private sector lost 33,000 jobs in June, badly missing expectations for a 100,000 increase. And why were there expectations for a 100,000 increase anyway? Because Jay Powell said so. He said the labor market is strong and resilient. Well, actually, he shifted from strong and resilient to solid when we keep getting all of these warning signs that from the market to other data points that have said the U.S. economy is joining the rest of the world in worse than forgot how to grow. And as CNBC continued, private sector hiring unexpectedly contracted in June. Payrolls processing firm ADP said on Wednesday, in a possible sign that the economy may not be as sturdy as investors believe as they bid the S&P 500 back to record territory. And you can even hear the shock in the text that Jay Powell said everything is great and now it's not. We're getting more evidence that it's not great. I mean, it was just taken as a given. It was taken on faith all over Wall Street as the stock market roared back from its tariff lows. And as CNBC finished up, private payrolls lost 33,000 jobs in June. The ADP report showed the first decrease since March of 2023, back during the bank crisis. Economists polled by Dow Jones forecast an increase of 100,000 for the month. The May job growth figure was also revised even lower to just 29,000 jobs. So that when you look at the ADP data, it's not just the month of June or the month of May. There is a clear deterioration, a clear downward trend in ADP's figures, which fits with a whole bunch of other data, starting with the consumer numbers, spending as well as income that we went over a couple days ago. The economy is exceptionally weak, and we continue to get more and more confirmation of not just weakness, but weakness that it represents a transition from forgot how to grow to remember how to do worse. More and more evidence for the transition to the flat part of the beverage curve. Now, what ADP itself said was, though layoffs continue to be rare, they always throw that spin in there, a hesitancy to hire and a reluctance to replace departing workers led to job losses last month. Still, the slowdown in hiring has yet to disrupt pay growth, talking about taking the most positive spin on all of it. But this is exactly how I told you it was going to happen. If you remember the Beige Book from the Federal Reserve, the Beige Book back in January, they said layoffs weren't happening. At the very start of the year, the economy, the labor market, everything was fine and solid. Then a couple months later, they said, okay, well, there are scattered reports of some companies that are planning to cut workers, as if that's totally consistent with a strong labor market. Now we're at the stage where they say, okay, yeah, layoffs are happening, but at least they aren't pervasive. They're kind of rare, as ADP's economist just said so. And even if that's the case, it still represents a substantial, meaningful change in employment conditions that consumers have been warning about, like markets, this entire time. And what happens after all this, as the layoffs become less and less rare, they'll say, okay, well, layoffs are becoming less rare, they're more pervasive, but it will only be transitory. It'll only be temporary weakness, and things will be fine in a couple months. You'll see. Going back to ADP's report, most of the job losses were concentrated in small and medium-sized businesses. They show the smallest class of employers, which are those with 1 to 19 employees, as losing almost 29,000 jobs on net. And the next step up, those businesses with 20 to 49 employees, they lost 18,000, so more than 40,000, almost 50,000 just in the smallest tiers. And the smaller businesses are where layoffs are going to ramp up. Job cuts at bigger firms will make the headlines, but it's the unnoticed smaller employers who are already struggling, and they're the ones who are going to be doing the job cuts, which is why these layoffs will seem quote unquote rare, at least at this stage. And on top of the smaller businesses, ADP even showed a net minus 27,000 for mid-sized, those with 250 to 499 employees. And most of the job losses were concentrated in the services industry. As we've been pointing out, that's where all of the negatives have been focused. As far as consumer spending and discretionary spending, weakness in services. ADP has a net job loss of 14,000 in financial activities, a pretty substantial job loss, a net minus 56,000 in professional business services, which is a key cyclical indicator, as well as another 52,000 net job losses in education and healthcare. While they still show a plus 32,000 in job gains for leisure and hospitality, Americans do love their leisure and hospitality, bars and restaurants and the similar. That's still a low figure for this economy that has depended upon waiters and bartenders for job growth to such a high degree over the last really 20 years. So while ADP shows net job losses, what they're really saying is that hardly anyone is hiring, but now we're starting to see a few firms begin to fire. That's exactly what Challenger, Gray, and Christmas reported today in their monthly report on job losses, job cuts, and announced hiring plans. As Challenger put it, and what they saw, in June of 2025, there were basically the same number of layoff announcements as last June, which was already elevated. But the second quarter overall saw 247,256 job cuts, which was the highest second quarter total since the more than 1.2 million that were announced in 2020. And that's up 39% from the second quarter of last year. And so far this year overall, companies have announced nearly 750,000 job cuts, which is the highest year-to-date total since 2020, or outside of 2020, you're going back to, of course, the first 6 months of 2009. So there are announcements among the bigger firms of layoffs taking place, or layoffs that are going to take place. But at the same time, we also get more confirmation that no one is hiring. So you've got the no one hiring and starting to see more firing. Therefore, like ADP, the balance now moves in the direction of a negative payroll report. As Challenger said on the hiring side, through June of 2025, U.S. employers have announced a little bit more than 82,000 planned hires, which is actually a nearly 20% increase over this point in last year. However, hiring activity remains historically low, particularly when compared to the surge in hiring during the post-pandemic recovery years, which was just a reclaiming of jobs that had been lost. But most of that hiring was concentrated, or those hiring plans were concentrated in the single month of February, artificial tariff distortion high. As Challenger puts it, the highest monthly hiring announcement in 2025 occurred in February with nearly 35,000. Since then, numbers have declined, the payback that we've been talking about, with just 3,000 hires in June, the lowest of the year so far. And in fact, the monthly average for 2025 is currently just 13,800 compared to 64,000 in 2024 and 123,000 in 2022. Again, no one is hiring. In fact, there's fewer hires now. There's a little bit more in firing. And the entire center of gravity in the labor market is shifting in the wrong direction, and doing so in exactly the way the markets have been warning about. It's exactly the same way that consumers have been warning about. Consumer sentiment was not about tariffs. It was about jobs, incomes, and the prospects for exactly what we're seeing. No hiring and no firing becomes even less hiring and now some firing. So this is just the other side of the swap market, the macroeconomic real deterioration from consumers as a reflection of labor market conditions. As I pointed out yesterday, swap spreads remain alarmingly low, scraping along at near record negatives. In fact, both the 10-year and 30-year maturities last week on Thursday came close to setting new record lows and are only barely above them. And they've stayed barely above them ever since April. While the stock market has roared back from the bottom, at least certain parts of these indexes have roared back, the swap market, the rate curves, and a whole bunch of others have barely even moved off of the April lows. A huge warning about macro as well as money. I mean, what do extremely negative swap spreads signal? On the very basic level, all they say is that short-term interest rates, therefore all the rest of interest rates, are going to go down a lot and stay there for a long time. So the macroeconomic data, along with the monetary conditions that we keep seeing, are aligning with that view. How do we get to lower for a long, long time on interest rates? Increasingly unmistakable labor market deterioration would be a big part of triggering at least the first part of it, getting rates down in the first place. And that's the confirmation that we keep getting from all over the place. This thing is real. It's not strictly sentiment. It's exactly what the markets, especially the swap market, have been pointing toward all of this time and pointing toward more confidently as time has gone on. And the data continues to confirm why that's the case. It continues to align with that direction rather than deny it. All of this is more evidence to the growing pile for the shift in the beverage curve. Remember, the beverage curve is just a visual representation of weakness in the labor market. We're looking for clues that the jobs market is indeed shifting on the curve, away from the vertical part and into the flat part. That's where we go from initially falling demand for workers, which means fewer help wanted ads and really less hiring. But at some point, this flat part transition, the demand for workers drops so low, it means there isn't even enough demand for the workers that companies already have employed. And at that point, the economy switches from no hiring, no firing to no hiring and more firing, and eventually no hiring and a lot of firing. So the evidence that we keep getting points to that stage where we're at no hiring and actually less hiring and some firing. Well, we're at the stage that we're only seeing a few layoffs happen. They are happening. We keep getting confirmation of it, and therefore it fits right into that transition in the beverage curve from the vertical to the flat part. Exactly like what the markets have been pricing all along. How do you get interest rates to go down? Exactly what we see here. So again, it's not strictly deeply negative sentiment. We keep getting more and stronger confirmation from all over the economy, especially in the jobs market, as well as outside the US too. So negative jobs data certainly fits with interest rates that are going to go down and go down a lot. And it fits with the broader macro trajectory, the transition to the beverage curve representing the shift from forgot how to grow to remember how to do worse. And it also fits with what we see on the money side of swaps, which is more and more intense deflationary outbreak potential. Went over that in Treasury bills yesterday. So the next thing is, once rates do go down, what ends up keeping them there for the long haul? Is it the size of the contraction, the length of it, something else, a combination of everything? Given everything that we're seeing from ADP to Microsoft to beyond all of it, those are the questions that we should be asking, not whether or not Jay Powell's mood will shift over the next couple of weeks. I mean, we've already seen it in the holy grail of hard economic data. The personal spending and income figures from the Bureau of Economic Analysis, that's all in the video link below. As always, thank you very much for joining me. I hope you can join me on July 10th for our webinar. There's a link in the description to sign up. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.